Rajkiran Rai joins us, represents Union Bank. Let's connect with him to understand how things have transpired for the quarter gone by. Has the new credit cycle started? And NPAs, which we would always ask Mr. Rai on NPA. This time I shall not start with a question on NPA because they're under control. Good morning. So good to have you back.
Good morning. Good morning.
Are things looking up or are things looking really up?
Yeah, I can say things are looking really up actually. On every front, the performance is extremely good. I'm very happy with the results.
Uh, the worst of the NPA is behind every major bank, and a new credit cycle has started. That is a broader understanding. But if I look at your credit offtake numbers, the credit offtake somehow is not all that exciting. So while things are looking up, NPAs are behind us, corporates are borrowing more, working capital requirement is going higher, everything is good. But sir, why are they not showing in numbers?
Yeah, it's a close to 10% credit growth. I think
10% is not much. I mean, considering the base and considering the positioning of the bank.
I agree. Actually, the credit is a function of the demand. So it is again linked to the new investments happening in the economy and the demand. So when that starts, banks are ready to lend. Now, if you look at the banks, we are sufficiently capitalized and we have adequate liquidity. There is a good deposit growth also. We are ready to lend, but then we need to get enough space to lend. So I think that is slowly getting created, and double-digit numbers in the year 22 is good actually. Like looking back of the COVID period, the shrinkage, what happened, I think, and the deleverage, what we saw in corporate credit, I think it's a very good number. And this year it will pick up.
Okay. It's good, sir, but I'm hoping that next time when we interact, I will use the word great instead of good. Okay, now give us a sense of where the demand is coming. Has demand come both in term loan as well as working capital requirement?
Yeah, actually, what we saw on the working capital side, actually, the highly rated corporates looked at other avenues other than banks also, because of the huge liquidity in the system. They could really mobilize some at cheaper funds. So that's why actually the deleverage of corporate credit happened on the working capital side. On the term loan, we continue to be the biggest lenders, but then it takes time. Actually, even I have about 28,000 crores of sanctioned credit lines yet to be dispersed as of 31st March. And we have another 30,000 crores of in-principle sanctions in hand. It takes time because actually, if you are looking at sectors, it is mostly coming from infra as of now. But then we also see a lot of capacity expansion in textiles, chemicals, and other areas also. And NBFCs are again back to borrowing, and we saw a good credit offtake from NBFCs also.
Right. Mr. Rai, the one thing that stands out to me is that what one is seeing in the quarter gone by is also a case of higher provisioning as well as credit costs. I just wanted to understand, in terms of stress around various sectors, where is it that you're currently facing stress and where is it that you anticipate stress build up in the quarters to come?
I think stress book has gone down substantially.
Yeah.
The stress book, what you call SMA 0, SMA 1, SMA 2, is hardly one third of what it was in 31st March of 21. On March 22, it is hardly one third. So I think the stress book has really, really gone down, and the effective monitoring and collections actually have played out very well. So I don't see further slippages happening. It will be well controlled.
Okay, good to hear that. Um, the other thing that I wanted to understand is also what part of your book is floating rate, and will increasing rates then aid your top line going forward?
More than 80% of my book is linked to floating rates, whether it is MCLR, EBLR, and Treasury being linked rates. So with that, actually, we are well protected with the increasing interest rates. They get repriced. So we are in an advantageous position with the price increase, with the interest rate increase.
Morning. This is Nental also joining in the conversation. I want to speak to you specifically about one account which was in the news recently, and a lot has been spoken about it. I am talking about Future Retail. With the Reliance Retail now off and the lenders rejecting it, the street is quite unhappy. What was the rationale behind this, and how is all of this going to be taken care of?
There we banks had their own reasons. Actually, initially when the offer came, it was on different lines, and when the offer came for in the last minute, it was totally different from what it was, and it was not in the favor of lenders. Definitely, it was lacking the kind of commitment needed. So I think maybe based on that, actually banks took a call to reject this offer, and we told the company to come back with a better offer, much better offer. So the issue has not closed. Basically, we were not happy with that particular offer which came, but then definitely we will be working with the company to get an improved offer. This has still a lot of business value and brand value. So definitely we are expecting that some kind of solutions will emerge. But there are a lot of legal issues around this, which is really holding back.
Okay, so we still have to figure out how this issue is going to be resolved and how the account, of course, is also going to be resolved. So there have been reports that the RBI Governor, Shaktikanta Das, will be meeting with the PSU banks, particularly today, to talk about their strategy in a regime where interest rates are going up so that credit offtake doesn't get hurt as well. What can we expect today? Is that meeting on, and what exactly is the idea?
If required, I'll talk after the meeting. Right now, I can't speculate on what is going to come.
But what is the strategy for the for a time when the interest rate rates will be going up?
Actually, there are two ways. We look at it. Actually, basically, when the interest rate goes up, one is from the bank side, the earnings will also go up. Actually, but other side is there will be shrinkage of credit demand. So that is another angle we have to look at. And the immediate impact comes on the retail side. So actually, retail, all the banks have done very well in the last 2 years. The growth is also very good, particularly the housing demand and even in the agriculture sector and all that. And the interest rate going up, actually, it is expected that some demand shrinkage may happen. That is one area which we have to manage. But the kind of like with the 50-100 basis points, actually, I don't think there will be major change in the demand situation as of now. But then we need to wait and see how the liquidity in the system gets absorbed, and also how fast the interest rates go up, and how the system reacts to that, and whether really there will be demand shrinkage. So I think it will be too early to comment. I don't see the major impact during this year. Our credit projections for this year, we don't see that will have impact. But going forward, there can be a situation where there can be demand shrinkage.
10% is what you've reported for the quarter gone by. Could it be 12? Could it be 14? Could it be 15 plus? Credit
we
growth.
expect 12. Actually, that is our projection. We have given a range of 10 to 12, but 12 is what we feel that is a reasonable number. Actually, it could have been better, actually, but for this inflation coming. Otherwise, actually, maybe a few quarters back, we were looking at a really high credit growth this year. That was the way it was building up. Our discussion with the corporates was showing that, enthusiasm and optimism. But with the inflation and the rate cycle reversing, I think we had to realign our priorities now.
What could be the hit on the treasury operations because of yields? And if yields continue to go higher, that is one chunky income which you had, let's say 3 quarters ago, 4 quarters ago, now goes off.
Yes, actually, there's one area of concern, but particularly for Union Bank, we are well covered ourselves on the AFS portfolio. That is where the mark-to-market losses come. So we have brought down, because it is expected that the rates will go up for some time. So we have worked, my treasury team has brought the duration down substantially. So we are still not making any mark-to-market provisions. In the Q4 also, we have not done anything. And we hope, actually, with the estimates what we have, we think that we are safe up to 6.75, 6.80 kind of rates. After that, definitely, there's a 10-year benchmark I'm talking about. So basically, beyond that, yes, there may be some mark-to-market provisions, but they're not huge because we have shifted to floating rate bonds, treasury bills, and other area in the AFS book, which is giving a good cushion. So we don't foresee big mark-to-market provision. But on the earnings side, yes, what you say is right. So we expect the treasury income will go down by maybe 50% compared to last year. But then we are confident that that will be more than made up by the increasing interest income. So we think that like the compensation will happen from the interest income.
Let me summarize our interactions, and please correct me if my summary is wrong. If I say that Union Bank has provided for every major doubt line, whether it is COVID or non-COVID, so that book is that the provisioning part is clear. Now a new cycle has started and you are confident of keeping a double-digit credit growth on a largish base for FY23?
Yes, actually, I think the books are with the 83% provisioning. What you say is right. Even the two chunky accounts actually which slipped during the year. One account I am holding 86% provision. Another account I am holding 58.5% of provision. So we have actually taken the hit upfront. So the next year the aging credit cost is less than 1. So I think the credit cost will substantially come down, which will result in better net profits. Your assessment is right. We are sufficiently provided for all kind of bad book. And there is a doubt that the restructured book may slip and all that. There also, when I say my stress book is well under control, it is in very low single digits. So that includes the restructured book. So we are not seeing major slippages also happening next year. So I think we are in a good situation to show ROA of 0.75 next year.